Good morning,
Good
sir.
morning. Good morning, sir.
Okay, sorry for starting the class late. I needed to do something this morning. That was why. So sorry. Okay, in our last class, we're looking at um, company's income tax, right? And we spoke at length on the meaning of complaint, the meaning of Nigerian complaint. We also went ahead to discuss in class filing of returns by company. We discuss all that. We discuss filing of returns, filing of returns by company. And I told you today we are going to be discussing type of tax liability that company pays. That was what I said we're going to do today. So that was what we discussed in our last class. Let me know if you can see my screen. Trying to broadcast my screen. Can you see my screen? Can you see my screen?
Yes.
Yes, sir.
So, and that's been, do you see filing of returns by company? I typed it.
It's not showing yet, though.
It's showing I'm sharing my screen already. So, okay, let me see if I can. So today, we are going to be looking at payment of tax liability by company. Payment of tax liability. Can you see my screen? Payments of tax liability by company. So, when you talk about payment of tax liability by company, I told you in my last class that four scenarios occur when you want to file, when you are paying your tax liability. The first scenario is where you pay dividend by tax, when you pay tax on dividend. When you pay tax on dividend, that is first scenario. Second scenario, when you pay tax liability on your turnover. When you pay tax liability on your turnover. The next one is when you pay tax liability on your total profits. And the last one that is very important is tax liability on minimum tax. So these are the things that we discussed in my last class, and we are going to continue from there. So I said the first one, tax liability on dividend. Second one, tax on turnover. 3, tax on total profit. And 4 scenario, we talk of minimum tax. Now we'll pick it one after the other. I will dive into this. We'll dive into this. So now there could be a scenario. So I'm going to start with this tax payments on dividend. Now, what are the scenarios in which a company will be required to pay tax on dividends? Section 19 of CETA states that 1, where the company makes no total profit. 2, where the company makes total profit, but the profit is less than dividend declared. Then, if these two scenarios occur, then the company shall mute your mic now. We have gone beyond this. Shall be assessed to tax on dividend. I've said scenario 1, the company makes no total profit. Scenario 2, the company makes total profits, but the total profit is less than the dividend declared. Then what would happen? Then the company shall be assessed to tax on dividend. This is subsection 1 of the Act. Section 19, subsection 2 of CETA gives exemptions to this. Now, what are the exemptions? The exemption says where the dividend is paid from the following. The dividend shall be exempted. Who is using my marker? We have started this with Wabi. I'm coming. So we just go and be pressing what they are not supposed to press. Don't take my marker from you. Yeah. So the answer is, if dividend is paid from the following, then the dividend shall be exempted from tax. Hold on, it's coming up. Shall be exempted from tax. Now, what are we talking about here? Number 1, if the dividend is paid from, if dividend is paid from retained earnings, then it should be exempted from tax. If the dividend is paid from, dividend is paid from profits already exempted from tax by the provision of capital gains tax EPT and Pioneer Legislation Acts, then such a dividend will be exempted from tax. The next situation where dividend can be exempted from tax is where the dividend is franked investment income. And number 4, where the dividend is a distribution to shareholder of a real estate investments company, provided that at least 75% of the dividend is distributed. And third, within 365 days to the shareholder. So that is that. Do you have any question? Any comments? Any question? Any comments? Okay, in the absence of no question, we'll move on to the next concept. Now,
Sorry, sir. Good morning, sir.
good morning.
Sir, please throw more light on this number 4, dividend that is distributed to shareholder and all that.
So we are saying that where the dividend is a distribution from a real estate investment company, so the dividend will be exempted from tax. Okay, and when is it going to be exempted from tax? It also has a provision provided at least 75% of the dividend is redistributed to the shareholder within 365 days. That is, when the distribution is made by the real estate investment company, okay, they have distributed at least 75% of it to the shareholder, and the shareholder, they have distributed to shareholder, and the shareholder in turn redistributes at least 75% of that within the year. Okay, now let's look at some scenario. Open your study pack. I think there's some scenario in your study pack for us to dive into this. Is anybody new in this class? Maris, you are new in this class. Benga Joseph, you are new. Even if you are not new, introduce yourself. I don't know you. That's the meaning.
Yeah, my name is Benga Joseph. I'm not new in the class.
You are new because I don't know you. How are you?
I'm good. I remember I sent you text message during the week.
Okay now.
Yes, but you didn't respond. Or maybe you're busy or something.
Let's take that out of the class. Send me the text again. Let's see what you ask me.
Okay.
I can't remember.
Thank
Maris. Maris, are you in class? Okay, let's leave Maris alone now. Maris say you no dey class. Okay, let's look at your study pack where you have company income tax. Let me see. Maybe a lecturer puts this. Page
Hello,
2.
sir. Morning, sir.
Good morning.
Yes, sir. I wanted to ask, this special exemption for investors in real estate company, is it because government want to encourage people to invest in that sector?
You know the answer. You have answered the question.
Okay, sir.
Good morning, sir.
Yes, good morning.
My name is Marius. I'm not new in the class. I was having an issue unmuting my mic.
Okay. Thank you, Maris.
Welcome, sir.
Yeah. So I'm trying to look for a question that will suit this discussion. Okay. Go to page 269 in your study pack. Page 269 in your study pack. You remember, we said if dividend is paid out of retained earnings, if dividend paid out of retained earnings is exempted. So let's see an illustration. Okay. An extract from financial statement of Dividend Limited for 2019 shows the following. Accounting loss. $500K. Retained earning. $2 million. $1 million. Dividend declared.
Sorry, excuse me, sir. You mean page 269?
Yes, sir. 500. Now, in this scenario, when you look at it very well, the company distributed 500K to shareholders. Where did this company see the 500 that they distributed? Where did they see it? The company did not make profits. You remember the conditions that we spoke about. We said number one, section 19, subsection 1 says where there is no total profit or there is total profit, but the total profit is less than dividend declared. What will now happen? In this case, the company shall be assessed for tax on dividend, right? So this is section 1. So if you want to look at section 1 now, the company makes no profits. That means the company shall be invariably assessed tax on dividend, right? That is section 1. But section 2 is now saying, no, do not assess the company to tax if the following play out. If you notice that the dividend is paid from retained earnings, it is paid from frank investment income. It is paid from profits already exempted. And if you paid it from distribution to shareholder of real estate investment company. So if that is the case, that means this company has to follow subsection 2. Now, in subsection 2, you will notice that retained earnings, when the company made loss, there is no way the company would have paid dividend, isn't it? Is that not?
Yes, it is, sir.
Good. Now, the company made loss, but they still went ahead and paid dividend. So if I may ask you, my dear student, where did they get dividend from?
Retained earnings.
Good earnings.
Retained earnings. And by implication, what would happen to that? This dividend, what will happen to it? It will be
It won't be that.
exempted, yes, from tax. Now, when I say the company shall be assessed tax on dividend paid here, it means at the rate of 30% of the dividend. Okay? What is that? So that means this company shall be exempted from tax. Let's go to the next scenario. Now you understand it. So you didn't want to interpret the next scenario. The next scenario is number 2. The company made a profit too. Profit 1 million. Retain earnings 2 million. Dividend 1.5. Who can interpret this scenario for us?
Hello, sir.
Yes, I'm with you.
Yes. So a part of the dividend, that's like 500,000, has been paid from retained earnings. Portion of the dividend.
That means 2 scenarios. 1 million from profits, 500 from retained earnings. This, by implication, is not exempted from tax, isn't it? Not. This profit is not exempted. So the company will pay company income tax on the profit at the rate of 30%. Meanwhile, the 500K will be exempted from tax. The 500K will be exempted from tax. Do you understand that? Because by implication, it means that this 500K was from retained earnings. And the fact is that because it was paid from retained earnings, it shall be exempted from tax completely. Okay? So what is going to be shared with tax is only the profits. But by going on the first principle, section 1, that says no total profit, but there's total profits, but total profit less than dividend. In that year, before the amendments, would have subjected this company to tax on dividend. That is 1.5 million, not on the 1 million. But because we now know better understanding has come, you know that dividend was actually paid from the profits. Then it should be exempted from tax. Let's look at another scenario. Another scenario. Another scenario. Scenario number 3. Profits. 52 million. Retained earnings. 105. Dividend. 42. So what can you say about this? What can you say about this?
Hello, sir. So the dividend is from profit, since there's no date.
The dividend is from the profit. Okay, good. So the dividend was paid. The dividend was paid from the profits. not from retained earnings. Therefore, by implication, the dividend is not exempted from tax. Do you understand? That's what it means. Any
Just
question?
for clarification, sir. In this scenario, is the tax going to be paid on the profit alone or going to be paid on the profit and the dividend?
No, it should be paid on the profits. Do you understand me?
Okay, I understand.
Because
Why I
what we
said
are trying to say here, I'm coming. What we are trying to say here is that the profits is actually what gives rise to dividend. Do you understand? Profit gives rise
yes,
to
I
dividend.
do. Thank you.
That is right. So we get it from the profits, not from the. We don't need the dividend. The dividend is just for us to make an illustration. Do you get it?
Yes, noted.
Yes.
Thank you, sir.
When you look at the other scenario too, you will see that this profit, we said when we're trying to divide the dividend, we said the dividend is made up of profit and retained earnings. You can see that we did not say we are taxing the dividend separately from profits. Do you get? So it's the same principle that applies. Now, classwork for everybody. Can you quickly look at question number 4? And give me the scenario. Who is helping us out? Question number 4.
Okay, sir. For question number 4, my opinion is that the dividend, the tax for that year should be based on the dividend declared of 14 million instead of the accessible profit of 10.9 million, considering the fact that they are declaring what is above the profit they aim for the year, and they're equally saying for recent time they are having a declined activities. So that's to say the tax for that year should be 4.2 million.
What are you basing it on? The dividend, have we?
Yes, sir.
Okay. In this question, they have retained earnings.
No.
There is no retained earnings.
No, sir.
Okay. So if there is no retained earnings, your solution is correct. But if there is retained earnings, let me look at the question myself.
But sorry, sir, they didn't give us retained earnings, but from the discussion, it's assumed that
Don't assume. Don't assume.
okay, but they said they have a standing policy to be paying dividend, but their activity for that year was dwindling.
Don't assume. In the question, whenever you do not see retained earnings, apply section 1 of the Act.
Okay, sir.
Apply subsection 1. Do you understand?
Yes, yes.
Assuming they add retain earnings to the question now, then we can go ahead and do. Okay, the next one, illustration number 5. Can tell us what to do. Illustration 5. What will be my answer? In this illustration, we have accessible profits of 8.1 million. And they have capital allowance of 5.8. What is my total profit? This will be 2, 3. They now declare dividend of 5 million. The examiner deliberately told you retain earnings is nil. That means this company has some money that they have eaten and they are now paying from it. I don't know how they got that. So the implication of this is that section 1, subsection 1 will be applicable. Subsection 1 will be applicable where total profit is less than dividend declared. The company shall be assessed with tax on dividend. Okay, so that's, I'm done with that. Let's talk about turnover assessment. So company could also be assessed with tax based on their turnover. Company could also be assessed with tax based on their turnover. And how do I mean? In that regard, it means that company will be assessed with tax on their turnover if the following occur. Number 1, if there is no accessible profits. Number 2, there is accessible profits, but it is less than expected as compared to similar industry in the field the company operates. Do you understand what I'm saying? What we are saying here is that company will be assessed with tax on turnover where number 1, there is no accessible profit. Number 2, there is accessible profit, but the accessible profit is less than expected. Okay? Therefore, if these situations occur, the relevant tax authority shall assess the tax payer on a fair proportion of the turnover. So the company or the profit is less than expected, then such a company shall be assessed a tax on the turnover. Now, the turnover that the company is going to assess them shall be fair proportion of the turnover. Okay, so the fair proportion in recent times that government has implemented is 20% of the turnover, or 10, depending on their discretion. So they will assess the taxpayer to tax based on discretion. So that's that. Any question? So your question now will now be, how do you get the fair proportion? The second will give you the fair proportion. Let's quickly talk about minimum tax. Section 33 of CETA. Section 30 of CETA. What does it say? Company will be assessed to tax, will be assessed to minimum tax where the following are called. Number one, where there is no total profit, or where the company makes loss. Number two, where the company income tax computed is less than the minimum tax. Number three, where the profit of the company results into no tax paid. So these are the steps. Scenario number one, we said where there is no total profit or the company makes loss, such a company shall be assessed to tax using minimum tax scenario. Number two, we said where the company had computed company income tax based on the various criteria, and the company income tax is less than the minimum tax computed, then the minimum tax will be applicable. The minimum tax should be what? Will be applicable. Number three is that if the company has a profit that results into no tax paying, then the company shall be assessed a tax or minimum tax. Okay, can you give me, do you have any question? Any question?
Yes, sir. Please, can you explain the last one again? Number 3.
Okay. So that number 3, what I was saying is that the company will be assessed with tax where the profit they make results into no tax payable. So this is what we mean. There are some profits of the company exempted from tax. Okay. Now, let's now assume that all the profit of this company that they have is profit that is exempted from tax. Then that means they will not pay tax, right? So minimum tax now saying that if that's the situation, minimum tax will become applicable.
That you
Okay.
wrote instead of tax payable.
Okay, let's go.
Sorry, sir.
Oh, yeah.
Please, maybe I didn't hear you. What is the situation for a profit that of a profit of a company that results in no tax payable?
Okay.
Because in my head, I was thinking pioneer company, but pioneer company will not pay tax in such situation too.
We are not referring to pioneer company here. There are some companies that's, there are some profits that are exempted from tax. For example, profit or disposal of fixed assets is exempted
Okay.
from tax. For example, sales of investments is exempted from tax. Let us now assume that that is the only thing that the company did that year. They will make loss because, number one, that their profit is not taxable. Abi?
Yes.
Mm-hmm. Because the profit is not taxable, you cannot do anything with it. That is why we
Okay.
said if the
I
profit
get
is not
that.
taxable, then minimum tax should be checked.
Thank you, sir.
All right. Companies exempted from minimum tax. Number one. So these are 3 companies exempted from minimum tax. Do you have any question? Minimum tax is computed as follows. Turnover less frank investment income. This should be net turnover. Okay. Any question?
Hello, sir. Sir, I wanted to ask the point you were making about having to pay minimum tax when maybe that is all that the company, maybe disposal of asset is all that the company did for the year. When the company disposes assets, are we saying that in addition to paying capital gain tax, the company will still be subjected to paying minimum tax, sir?
I've answered you.
I didn't hear you, sir. Maybe network.
Are you looking at the board?
Okay.
Now, it is a different regime. Capital Gains Tax Act is not the same thing as Company Income Tax Act. So under the Capital Gains Tax Act, do whatever you want. But here, that is what the company. Do you understand what I'm saying? So for capital gains tax, we will pay the regular capital gains tax rate of 10%. But for company income tax, you are not paying. Then minimum tax will come up. So for you to calculate your minimum tax, you say your gross turnover less frank investment income. Frank investment income is the same thing as dividend. Okay? Now let's go. Turnover is not the same thing as revenue. In taxation are not the same. Okay? What is gross turnover? This is the aggregate of all the income of the taxpayer. Arising from ordinary course of business, arising from ordinary course of business, comma, investments, open a bracket, royalty, interest, rent, and dividend. And any other income. So when you are dividing your, what's it called, your gross turnover, it is all income of the company. Okay? All income of the company. You will now deduct dividend from it, which is a franc investment income, and multiply by 0.5%. Okay? So that is that. When we get to question, we will solve many questions on that. So let's go to total profit. That is where my focus is on today. Taxation on total profit of the company. Now, total profit is the aggregate of all the profits of the company from various sources of income, comma, deduct loss incurred by the company in the prior or current period, as the case may be, and deduct capital allowance. Deduct capital allowance. So by implication, I am saying the layer of total profit is going to be your assessable profits less you have loss relief for the year, only for the year. Carry forward. We'll bring this guy in. They have total profits. Multiply by Your company income tax is at 30% of total profits, while your tertiary education tax is at 3% of accessible profits. Let's go. Now, I want to take it. You can see that when I wanted to compute my tax, I put at 30% or 20%. There is a reason for that. There is a reason for that. So we have types of companies. We have small companies, medium-sized company, and so let's take them one after the other. When you say a small company, according to the Act, a small company is a company with a turnover of 0 to 25 million. Medium is a company with a turnover of greater than 25 million, but less than 100 million. Greater than 25 million, but less than 100 million. The next one is the large company. It is a company with 100 million and above turnover. Any question? Okay. You remember when we were doing our concept of trading profits and loss adjustments, we had discussed the concept of allowable and non-allowable expenses. You remember? We had also discussed the concept of taxable income and non-taxable income. Now, all these principles is still needed. All these principles, the knowledge that you have gathered there Still very much needed. Still very much needed. So we will not be going back to that, but we'll still talk about some things that we did not fully discuss in the last class. Okay, let's talk about donation. Schedule 5 of CETA talks about donation. What is donation? And how many types of donation does a company has? Company has various two types of donation that is allowed under the law. The first one is donation, ordinary donation, which is gross called donation. And next one is donation by a company during exigency. Donation by a company during exigencies. Now, let's go. If that is the case, let's talk about the first donation. The conditions. Number one condition, it must be made out of profit. That is, if a company makes loss, such a company cannot donate. Therefore, donation must be made out of profits. Number two, it must not be more than 10% of the total profits. Now, it says it's more than 10% of the total profits. There is a caveat to that. Where donation is made to university or research and development institution, then donation shall be higher of 15% of total profits or 25% of tax payable. Number next. Donation cannot be capital in nature. except again where it is to tertiary education and research and development institutes. Number 4, it can only be made to the list of bodies established by government. So that is that. Now, another thing that is very important is this donation. Is that during exegesis, I'm done with this. Donation during exigency. You remember during COVID, a lot of companies were making donations. Were donating to companies. No, now, government now structure this and say you can now make donation. So for this, the donation could be donation shall be restricted to 10% of accessible profits. 2, donation can be in kind, or can be in cash or manufactured item. So the company can manufacture item and donate to the government, or the company can give cash donation to governments. Now, when I say to the government, I mean to the fund established by the federal government. So that's that. Now, another implication of this is that the donation must be recovered or recouped within 2 years, after which it will become lapsed. So that's about donation. Let's go to the next one. Another concept that you need to know. Any expenses incurred in generating tax exempt income shall not be treated as allowable expenses. So this is what we are saying. If you had incurred an expenses on an income that is not taxable, such expenses is not a reliable deduction. Okay? The next one, the next concept that is very important, that very important, is business reorganization. Business reorganization and restructuring. Business reorganization and restructuring. Who can tell me something about this? Who can tell me something about this? Assignment.
It's capital in nature.
Huh? Assignment.
I said it's capital in nature.
It is.
It's capital in nature, so it's not exempt from tax, I think.
Okay. Your assignment. Go and we are going to discuss tax implication of business restructuring, reorganization, and restructuring. So discuss the tax implication of business calling reconstituted tax implication of reconstituted business organization. These are your assignments. You are submitting them during the week. Submit during the week. What section of the act is it? Section 29 of CETA. That's what you're checking for this. And you are submitting next class. Okay. Any question before we?
So are we submitting on this platform?
Yes.
Okay.
Now, the next thing that we're going to talk about, once you do it, so let's continue. If you don't do it, I'll do as if it does not concern me. The last thing I want to tell you before I go today is book of accounts. This is section 67 or sit-up. All taxpayer must maintain a book of accounts where all records of the business are kept and it must be in English language. English language. Where the books of accounts are not kept in English language, the taxpayer shall be responsible for the translation of the accounts. Where the tax authority requests for the books of accounts and the taxpayer fail to produce the accounts, or the taxpayer shall be fined as follows: 100K in the first month of default, 2, 50K for every other subsequent month. Next, the book of accounts must be kept for a maximum period of 6 years after the year of assessment. So that is that you must keep the book of accounts for 6 years after the year of assessment. So we'll meet in the next class by the grace of God. We shall start computation on this. Good day to you, and God bless you. Any question before we go? Okay, we have some now.
Okay. Sir, let somebody share it like the class notes.
Okay, please someone to share it. Good day to you, and God bless you.